What if Wall Street's biggest secret was hiding in plain sight? A strategy so simple, yet so powerful, it's been quietly outperforming top investors for decades. No hype, no guessing, just a proven formula that tells you exactly what stocks to buy and when. In this video, we're unlocking The Little Book That Still Beats the Market by Joel Greenblatt, revealing how everyday investors like you can win in a game dominated by professionals. Trust me, you don't want to miss this. Point 1. The Magic Formula. Explanation. Greenblatt introduces the Magic Formula, a strategy that ranks companies based on two key metrics: high return on capital and a low earnings yield. It's designed to find undervalued companies with strong financial performance. This method strips out emotions and guesswork, relying purely on numbers and logic. It's ideal for everyday people who want consistent, proven returns without becoming finance experts. Example: imagine you're picking stocks like picking fruit. You want the juiciest, high returns at the lowest price, low valuation. The Magic Formula helps you find just that. For example, if one company makes 30% on its capital and another makes just 10%, you'd prefer the one delivering more value for every dollar invested. How to apply. Use free or paid screeners to rank stocks based on return on capital and earnings yield, then select the top 20 to 30 and invest in them equally. Hold each stock for a year. Sell the ones that no longer fit the formula and replace them with better-ranked companies. Tips: rebalance once a year, stay consistent, and don't panic during short-term losses. This system isn't for quick profits. It's built for compounding over years. Summary: the Magic Formula takes emotions out of investing and replaces it with a systematic approach that historically outperforms the market. By sticking with the process, investors can expect to beat most mutual funds over the long run. Point 2. Why most investors fail. Explanation. Greenblatt emphasizes that most individual investors underperform because they chase trends and let emotions control decisions. They buy high when everyone is excited and sell low when fear takes over. Classic mistakes that erode returns. Example: think of the 2008 crash. People sold low out of fear and missed the recovery. The Magic Formula prevents that. If you had held on to strong companies through the crisis, you would have seen massive gains by 2010. How to apply. Commit to the strategy, even when it underperforms short-term. Patience is the secret weapon. Don't expect instant results. The Magic Formula is a long-term play, often taking years to show full benefits. Tips: avoid checking your portfolio daily. Stick to the long-term plan. Ignore market noise and trust the math behind your decisions. Summary: success in investing isn't just picking winners. It's staying calm when others panic. The real edge is in discipline, not in finding the next hot stock. Point 3. Earnings yield and return on capital. The core metrics. Explanation. These two metrics are the backbone of Greenblatt's strategy. Earnings yield shows how cheap a company is relative to its profits, while return on capital reveals how efficiently a company uses its resources to generate earnings. Together, they tell you if a company is both a good business and a good deal. Two sides of the same valuable coin. Example: Company A generates $1 million in profit on $5 million of capital, returning 20%. Company B earns the same profit but needs $10 million, just 10% return. All else being equal, Company A is the better investment. Now, if Company A is also cheaper based on earnings yield, it's a double win under the magic formula. How to apply? Use stock screening tools to calculate and rank companies based on both metrics. Prioritize businesses with high returns on capital and low price-to-earnings ratios. The top 20 to 30 names on your list become your portfolio. Tips: look for companies with consistent returns over several years. It helps filter out flukes. Avoid firms with volatile or negative earnings, as they can distort the formula's effectiveness. Summary: these metrics help investors avoid overhyped, overpriced stocks and focus on quality businesses at bargain prices. Greenblatt's formula is a numbers game that rewards the patient and logical. Point 4. The importance of long-term thinking. Explanation: one of Greenblatt's key lessons is that great investing requires a long-term mindset. Markets can behave irrationally in the short run, but logic and value win over time. Most people give up too early, right before the compounding starts to pay off. Example: the magic formula may underperform the market in a given year or even two, but historically, it has outperformed over 3 to 5 years or more. Think of it like planting seeds. Don't dig them up just because they haven't sprouted overnight. How to apply? When using the magic formula, commit to holding your stocks for at least a year, ideally longer. Set clear rules and avoid tweaking the formula based on emotion. The longer you stick with it, the more likely you are to beat the average investor. Tips: measure performance in years, not months. Be prepared for the strategy to be boring at times. Remember, slow and steady often wins the race in investing. Summary: adopting a long-term perspective separates real investors from speculators. Staying the course is the hardest part, but also the most rewarding. Point 5. Keeping it simple works best. Explanation: Greenblatt believes that complexity often hides poor performance. His magic formula is simple by design, easy to understand, apply, and stick with. You don't need to read 100 financial reports or follow breaking news every day. Example: many hedge funds use complex models, but often fail to beat simple strategies like this one. Greenblatt's own firm managed billions using this exact method, with minimal adjustments. How to apply? Avoid the temptation to overanalyze. Stick to the core formula and trust the data. You can track performance yearly, rebalance, and repeat. Don't chase new tools, gurus, or secret systems. They rarely work better. Tips: set aside 30 minutes a year to update your portfolio. That's it. Focus your energy on living your life, not micromanaging your investments. Summary: the best strategies are often the simplest. In investing, clarity and consistency often beat complexity and chaos. Point 6. Beating the market is possible if you have the right discipline. Explanation: Greenblatt wrote this book to show that beating the market isn't about being a genius. It's about using a disciplined, logical approach. The magic formula has proven results, but few have the patience to follow it. Discipline is the real edge, not secret knowledge. Example: a disciplined investor using the magic formula outperforms most mutual funds over time. An emotional investor, even with access to the same tools, usually fails. The difference? One follows the plan. The other reacts to fear and hype. How to apply? Treat investing like brushing your teeth. Just follow the routine. No skipping, no drama. Review your portfolio annually, replace underperformers, and move on. The key is to keep emotions out of it. Tips: avoid the news cycle. Trust your process. Stick to your rebalancing schedule. Don't let a bad month or year throw you off course. Summary: you don't need luck to beat the market, just discipline and patience. Greenblatt gives you the blueprint. Your job is to follow it consistently. Conclusion: and there you have it, 6 timeless investing lessons from a Wall Street legend. The magic formula is simple, proven, and accessible to anyone willing to follow it with discipline. If this video brought you value, don't forget to subscribe, and hit the bell icon so you never miss insights that can change your financial future. Which point hit you the most? Drop it in the comments. I'd love to hear your thoughts.